Do you know that saying about the weatherman that that's the only job where you can consistently be wrong and still have a job? Not quite so. An economist, in my view, takes the cake, and then the weatherman comes after that. So let's take a look at the economists right now that are predicting a soft landing, meaning no recession. The Fed is going to do its job and bring inflation down to 2% without much harm to the economy. Here is the consensus for a soft or no landing. We are at 74%, and only 21% are predicting a hard landing. Now, there's no doubt that if you look at the bond market and the stock market, this enthusiasm about a soft landing is what is currently fueling this rally that we predicted correctly on this channel. We are back to the summer highs, which I said we can get back to by the end of the year. Go back and watch the videos if you don't believe me. It's all there. Now, should we believe these economists when they say that a soft landing is the most probable outcome? Well, lucky for you, lucky for me, unlucky for them, we actually have something called the internet where we can search articles going back to before the last major recession. I'm not counting the pandemic. That was more of a flash in the pan. But the last major recession that we had, we actually have articles dating back to just before the recession to see what the narrative was. So in this video, as always, we're going to be going through historical analysis. We're going to be going through data and facts to try to gauge where the economy is, what the market is going to do. And yes, of course, I will give you my take on where I think the stock market is going from here and what investments and trades I'm currently making after buying the dip, like I told you I would, at 410 on the SPY. That was my major buy point on the SPY. I also bought the dip on Tesla, and we started investing in bonds a few weeks ago. And by the way, a lot of this stuff you can find for free on my Twitter as well as my Instagram. So it behooves you to follow me on both Twitter and Instagram. On Instagram, I actually have a free trading and investing channel as well. You will find the links to both of those social media accounts below in the description. All right, let's get right into it. So as I said, 74% of the economists and financial analysts that were surveyed are predicting a soft landing. This is from B of A Global Fund Manager Survey. So let's take a look at what happened in 2006. In 2006, in December 2006, the projection for 2007, the overwhelming consensus view is for a soft landing with real GDP growth between 2.5% and 3%. Now, you might be asking yourself, why was there even talks of a landing? Well, because a lot of people don't remember this, maybe you were too young, but we were in a violent rate hiking cycle in 2006, just like we are now between 2022 and 2023, a violent rate hiking cycle that went from 1% all the way to 5.25% by the last rate hike in June 29, 2006. Now, it wasn't even as fast as the rate hiking cycle we saw now, where we basically took rates from 0 all the way to around 5.25% within the span of a year and some change. This happened over the course of 2.5 to 3 years. Now, remember that bit that I opened with about the weatherman and how that is the only job where you can consistently be wrong and still have a job? No, actually, an economist, as I said, takes the cake. Miss Yellen, if that name sounds familiar, that is our current Treasury Secretary. At the time, she was one of the Fed presidents under Chairman Bernanke. Now, she said back in 2007, she actually said, and this was in October 2007, this is from the FOMC meeting in October 2007, when we actually already started seeing effects of a recession. This is what she said. In summary, I think the most likely outcome is that the economy will move forward towards a soft landing. How does this lady still have a job? And not only that, she has one of the most important jobs in our government right now. Obviously, she sees a soft landing. The moral of the story is this: economists, financial analysts, CEOs, nobody wants to project a negative outcome, especially people that work for the Fed, especially people that are economists, where public policy depends on really them painting a rosy picture, not a realistic picture. Of course, the Fed is going to come out and say, yes, we think that, there's going to be a soft landing. Of course, people that work at the National Bureau of Economic Research are going to say that they really foresee a soft landing. Nobody's going to say, I actually think it's going to be bad, guys. So when you see stuff like this, never trust it. Just take it with a grain of salt. We have never hiked rates at this pace without without seeing a recession. We've never had a yield curve that was this inverted for this long. This is between the 10-year and the 2-year treasury without seeing a recession. Now, you might be saying to yourself, well, why did you long the market if you think we're going to hit a recession? Look what I drew back in, this was October 15th. This blue is my embellishment here. I thought that we would get back to near all-time highs, where close to where we are now, before then in 2024 seeing a drop. And that is pretty much my thesis now. Now, we could go past all-time highs. It really depends on the data points that we get every single month with regards to the CPI, etc. And if the Fed actually skips, which I think they're going to skip the next rate hike unless CPI comes in completely, above expectations. CPI is going to come in at December 12th, and then the Fed decision is coming in December 13th. So the Fed will have the benefit of seeing what the inflation data is before making a decision. Also, going back to 2006, June 29th was the last rate hike. And if you see, we hit a recession around October 2007, September, October 2007. So that's a year and 4 months between the last rate hike and the time that we actually hit a recession. This is why you can be nuanced and you can be bullish up until the point that we start seeing signs of a recession. The yield curve hasn't even uninverted yet. I think that we are months away from a recession, could even be a whole year away from a recession. So when you get these naysayers or these fear merchants online, I'm not even going to name names with regards to YouTube channels, but when you get these fear merchants online saying, how could you go long? This is the worst rate hiking cycle ever. You're delusional, blah, blah. Well, it's because I understand how the markets work. The markets need more of a reason to decline than to rally. The natural state of the market is to rally. I understand how volume works. I understand how the exposure from institutions work. Money managers are not just going to sit on their ass because some random YouTube channel thinks that we should be bearish forever. Of course, their job is to put money to work. So when the stock market gets cheap enough, based on what's the information that's already priced in, they're going to start putting money to work. And we saw this here. Part of the reason that I was so keen on going long in the market when I did, if you look at October 25th, that was the lowest NAAIM exposure. This is basically just a fancy acronym for National Association of Active Investment Managers, institutional money. This was the lowest institutional money invested going back to October 2022, which was the last market bottom. So when you see these extremes, these are actually times to invest. These are not times to shy away from the market. And now you are seeing some of those same YouTube channels, making videos about, hey, I'm bullish if the price gets above this. This is the time that I want to sell. I already did my buying. This is the time that now I'm thinking about selling. We actually did start hedging in the Traveling Trader Academy. We are up 34% on this QQQ put spread that I opened up as a hedge against my QQQ position. And I also put a pretty large position on gold. Those of you that are in the Discord know about this trade here. I put a pretty large position in gold because my thesis was that the dollar would drop after the Fed skipped the last rate hike, after inflation came in line. I expected yields to drop. With yields dropping, the dollar drops. When the dollar drops, gold rallies. And you could see my position here. I closed it out yesterday for $11,000 per contract on gold futures. By the way, we are going to be closing our monthly Discord. It is going to be invite and waitlist only. So if you want to get in before we close it up, make sure you use the code in the description of this video below. Our Cyber Monday code or whatever holiday code is still valid, but we're going to be closing it up and it's going to be waitlist only. So if you wanted to join, if you ever thought about joining, if you ever wanted to get insight into all of these plays, there is not a more complete group on the internet than ours. There's not a group that understands the relationship between bonds, between gold, between the dollar, as well as day trading indices, as well as day trading equity options, as well as hedging with neutral strategies like iron condors, diagonals, calendars. In my view, there is not a more complete group online. So make sure you get in on that action and let's continue with our market analysis. So where do I think the market is going from here? Well, if you take a look at what I was showing you earlier, the NAAIM exposure, you could see that we are roughly in range, right? This is normal range for the last couple of years of where the money managers, the capacity at which the money managers have their money invested. We did see this peak here in July 2023, which was actually the start of the correction. But in general, you see that we are in this range here. So as I said before, I'm starting to hedge. I do think that we might see a pullback after maybe a small rally in December. We are obviously coming up on summer resistance here. If we pull out the volume profile tool, this is one of the tools that actually helped me get in at that level. You could see here the most volume was at 410, which was the point at which I bought a lot of SPY at. You could see that the volume up here is very thin. Obviously, I think in the long run, the market will surpass this and the SPY will be in the 500s and then the 600s in the future. But we're talking about the short to mid-term. There is very thin volume here. So I would not be surprised with all the economic headwinds coming up. I would not be surprised to see us trading around in this range and not making massive strides in the short to mid-term. One of the other reasons that I went long is that the put-call ratio was above 1. And when you see this type of hysterical shorting, you know that the dumb money has now piled onto the shorts with the institutional money, and the market is likely to squeeze that dumb money out, and we are now back below 1. And when we get to below this 0.8 level, again, that's when I start wanting to trim the fat off of my long position. You could see here that the Nasdaq net long futures contracts, this is at a high, meaning that managed money is very long. And again, just like when there's a hysterical disproportionate number of shorts, I start to get worried for my longs when there's a hysterical disproportionate number of longs. All that would need to happen is that CPI comes in slightly higher than expected, and or the Fed actually raising another 25 basis points for this entire thing to come tumbling down. One other thing that I noted on my Twitter page was if you take a look at the crashes have happened during election years, and next year 2024 is an election year. So in 2020 was an election year, we had a crash. If you go back, the last election before that was 2008, where we had a massive crash. Obviously there was an election in 2012, but it was expected that Obama would get reelected because it's very rare that a president doesn't get reelected. So 2008, we also had a massive crash. And then if you go back before that, 2000, that's when George W. Bush got elected. We also had a massive crash. So 2024, I am expecting some things to shake up presidential wise, but if that lines up with the recessionary signals that we are getting, I would not be surprised to see a crash in 2024. The only thing, and this is what I was telling people, the doom and gloomers, the only thing is that the S&P 500 can rally close to 500 on the SPY, to where if we do get a crash, we are not going to crash below a major lower low, right? Like we might not crash below October 2022, and I don't think we're going to crash to the pandemic lows. The stock market is up 75% of the time. That means it is mathematically stupid to be a perma bear. Sure, there is times when it behooves you to be a bear, and that's fine, and you can go short the market. We do it all the time. But 3 out of 4 days, the market is up. So if you are a perma bear, meaning you want to be short every single day of the year, you probably shouldn't be in the market because you're automatically, mathematically pricing yourself out. And here we have another Fed member who is confident about his soft landing forecast. Surprise, surprise. So what I think will happen is this. In summary, guys, let me just give it to you. What I think will happen in summary, I think it will take a very long time for things like this yield curve to uninvert. I think it'll take a long time between the last Fed rate hike, which I believe was in July, and between a recession. Could be a year and a half, could be even 2 years from the last rate hike in July. These things don't play out very quickly, but I do think we will get a recession. The Fed just doesn't cut because they think it's cute. The Fed only cuts when something breaks. So in my view, if we are going to get a cut in 2024, it will likely be because something is unraveling. I will give the Fed credit for something, that they are actively trimming the fat off of this balance sheet. Went from 9 trillion to 7.8 trillion, and it is constantly going down after that small blip in a rally in the Fed's balance sheet that we had when the banks were crashing in March of this year. But I do have to give credit where credit's due, that they are actively rolling off assets off of the balance sheet. Let's see what happens when they start getting to 654 trillion. See what types of things break in the treasury market, in the economy, in the leveraged economy, the credit markets. So that is my thesis, guys, in terms of plays. Again, I am going to start trimming my long positions on indices and certain equities, not all equities. I do still love our Tesla play. We're getting about 70% dividend yield annualized on Tesla, and we are selling covered calls on top of that, supercharging it. We started investing in bonds, majorly up on TLT as well as TMF, which is basically the 3X leveraged ETF for TLT. I'm going to start a pretty fat position on ZT futures pretty soon because, as I said, I do think that the Fed's last rate hike was in July of 2023. That was the last rate hike. And if you go back and see how Treasury futures behaved the last time that the Fed paused their major rate hiking cycle, remember I said June of 2006 was the last time that the Fed actually hiked in that rate hiking cycle. And if we take a look at what happened to the 2-year futures, you will will see this insane rally here. Let me just go to it. You see this rally in yields from 2007 all the way, because obviously the Fed cuts rates during a recession, from 2007 all the way until we got to basically 2016. That was a 9-year rally in 2-year futures. So I'm expecting to set up a pretty massive play soon on 2-year futures, similar to the massive play that we set up on gold here. But I'm hoping to make at least 10, 20 times this amount and hold it for much longer than I did gold, which I only held for 13 days. Anyway, traders, that is it for this video. Hopefully, as usual, I provided you with some sort of value in terms of where we are in the economy and where the stock market is headed, based only on facts, only on data, only on history, only on rationale, no BS, no hyperbolic predictions here, no doom and gloom, just realism. If you got anything out of this video, leave it a big fat thumbs up. Come and join us before we close the group to waitlist only. You definitely want to do that, trust me. Leave a comment down below. Let me know what you think of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.